Sure. Or we might have got kicked out. Yeah. Hello?
Yeah.
Are you guys? Okay, you guys. Let's just let it know. Okay. Just want to make sure we're sharing. Yeah.
Perfect. All right. Well, I guess we will get started. I think I've done this correctly. Okay, well, I hope I've done this correctly. I guess we'll get started, and as people join, we'll just let them in if there are a few stragglers. Thank you, everyone, for joining the presentation this afternoon. It's been quite the week, and it's only Tuesday. So I'm sure the two gentlemen that I'm about to introduce will have quite a bit to say about that. This is our first attempt at this type of presentation, so hopefully technology is on our side. If not, I have my 14-year-old on standby via text message, and she can hopefully guide me through any troubleshooting. You'll notice at the top there's a chat button. So if you have any questions throughout the presentation, you can click the chat button and type in your question, and we'll try to squeeze in a bit of a Q&A session at the end of the presentation. Now, without further ado, I'd like to introduce our two speakers that have been kind enough to take time out of their day to speak with us and give us some context as to what we're currently experiencing. Lorne Gavsie is the Senior Vice President and Head of Macroeconomics and FX Strategy at CI Global Asset Management. He's responsible for leading and providing his global expertise and knowledge to CI GAM and offering timely insights to the various portfolios. He's responsible predominantly for currency overlay and hedging strategies. Lorne is a huge football fan, and both of his sons currently play football. Shankar is an economist at CI GAM. He monitors macroeconomic developments and central bank actions to inform CI's economic outlook. He's a contributing author to CI's Market Pulse and Deep Dive publications, where he shares his expertise on developments and trends. Neil's a big basketball fan. However, with two children under 4, the most basketball he gets to play is tossing diapers into the waste bin. So, gentlemen, thanks again for joining us. I will hand this over to you, and you can take it from there.
Great. Thank you very much for having us. Appreciate it.
Yeah, thank you.
Do you mind just getting the lining up? We're going to share some slides, some pictures, some charts with you, and tell you a little bit of a story and go through some of the what we would consider the key themes right now that are driving markets. Let's just make sure you're able. Just bear with us. We just want to make sure everyone can see things. One sec here. And Mike, can you just confirm that that's showing on your end? Perfect. Thank you. So often when I start thinking about what's going on big picture, I start with what I'll call infamous quotes. They typically come from, the Winston Churchills, former U.S. presidents, different people. And this one comes from a management consultant. So a little bit of a different narrator, but I thought it really held true in the current environment right now. And it's simply to say the greatest danger in times of turbulence is not the turbulence itself, but to act with yesterday's logic. Things are changing. The environment around us is changing. The U.S. political backdrop is shifting the global economic environment. So it's important to be on top of how things are shifting, to anticipate, to think about how to position portfolios or your investments. So at the bottom, the bottom line is we just wanted to spend some time walking you through how we're thinking about things and as I mentioned before, some key themes. So the things we're going to touch on are the market performance. So really looking at how things performed in 2024, whether it'll, make a comment or two as to whether we think it can be repeated or not. We'll get into, everyone's thinking tariffs. How can't you be, right? So tariffs and the uncertainty that they introduce. So we'll do a fair bit of talking about the tariff situation. A little bit on Canada. Setting the tariffs aside, the outlook is actually turning quite positive for Canada. Now, these tariffs could become a big obstacle, but we at least want to provide you with a bit of a vision, or share our vision on how things are moving forward in Canada. And then, of course, we want to talk about interest rates and the Canadian dollar, which are high on everyone's list of what is going to happen, those questions. So we'll try and answer those as well. So jumping right into major asset class returns. Last year, 2024, and arguably 2023, were exceptionally strong asset return years, meaning investments had exceptional performance. Just to give you a little description or explanation of what we're looking at here. So on the left, you can see a list of all sorts of different ways of slicing and dicing equity markets and bond markets and gold at the very bottom. The blue line is the 20-year range of annual returns. So during periods of deep economic recession, as an example, we've experienced some pretty severe returns on an annual basis. So that would really help you understand why there's been such significant losses annual losses at times over the past 20 years. And then equally on the far right, we've had some very strong performance. If you look at equities as an example, up plus 20% last year, a very, very difficult number to achieve on an annual basis. If you look at gold, another one that had an exceptional return, 27+% last year. Obviously, differing dynamics that are driving all of these returns. The underlying economic strength that we've seen, particularly in the U.S., but certainly the recovery that we've seen elsewhere, contributed to these strong returns. Obviously, the AI theme is one that we could easily point to. That's been a big driver for U.S. returns in particular. Bonds have been a little less strong on a relative basis, and part of that is not all countries, and this is look global bonds and Canadian bonds. Canadian bonds performed quite well because we saw interest rates actually coming down last year. That means strong bond performance. So you want to start high and move lower. That will bring you returns in the bond world. On the global side, bit more of a breakdown in the relationship, meaning it wasn't a singular move across all countries. So not all global bonds were moving in the same direction or at the same pace. We're actually going to show a chart a little later when we get into the interest rates. It'll give you a sense of, there's not the same level of coordination across global interest rates as there was going back 3 or 4 years ago. So with that, I'm going to jump right into the tariff story. The hot topic right here, right now. And the framework, or the way we're looking at tariffs, particularly through the lens on how it impacts Canada, is understanding the depth of these tariffs, what percent will be applied, the breadth, meaning will it be a broad strokes approach, which is kind of what we've heard so far from the US, or will it be targeted? So as the example of Canadian energy being adjusted down to 10%. And then the duration. A simple way to explain the duration is, will these come into effect and last for days, for weeks? Will they be permanent? Will there be a way to negotiate or adjust or appease Trump and his administration to then bring those tariffs lower? So a big question mark on depth. Now, we have an idea. We understand that they've announced 25% tariffs, although they've been delayed for 30 days. We have an understanding of the breadth, 25% across the board with the exception of oil and gas or energy. The duration remains a big question mark and a lot of uncertainty. So right now, Trump is trying to implement these tariffs under an emergency act. Called it, or the acronym is IEEPA, I-E-E-P-A. But the longer term tariffs would actually have to come through congressional approval or a different avenue. And that's why it raises questions on the duration of these tariffs. So, excuse me, on January 20th, on Inauguration Day, Trump signed a long list of executive orders. One of them was called the America First Trade Policy. And what it did was basically direct three arms of the US government, being the US Treasury, the Commerce Department, and the United States Trade Representative, or the Office of the USTR, to actually take a more methodical approach and investigate where are there uneven trade relationships, what are the proposals to remedy those unfair trade relationships, investigate where there may be countries who are manipulating their currencies to advantage their trade, and what are some of the actions that could be taken to offset those issues. So we strongly believe that this is what we need to be focused in on for that question of duration. So the 25% blanket tariff, of course, it's a negotiation tactic. It's a bit of creating a bit of chaos to generate some sort of response, uncertainty, arguably to weaken the counterparty that's at the negotiating table. We recognize all of that, and it brings a huge amount of uncertainty. But I think really at the end of the day, what they're trying to prepare the market for is these more methodical tariffs or potential tariffs. We don't know exactly, going back to the breadth and depth, exactly what they will look like for Canada nor other countries. We do suspect, and we're going to get into some of the details, that Canada may not be in the crosshairs as much as we have been in the headlines up until now, when they implement these, call it more pragmatic trade policies. So we're somewhat optimistic, but of course, the question mark is always going to be hanging over this question because of the uncertainty that Trump brings to the table. It's a difficult and challenging thing to put any kind of strong conviction behind. So maybe with that, I'll hand it over to Neil to go a little deeper into the tariffs, please.
Sure. Yeah, so thanks, Lorne. I think that was a good kind of summary of what we've been enduring over the past few days / weeks. And as Lorne highlighted, there's certainly a lot of uncertainty around the depth, the breadth, and the duration of these tariffs. And I think those are really the three key factors that will determine the economic impact on the Canadian economy. But we also wanted to share kind of the framework or the playbook in the way that we're thinking about how these tariffs will ultimately impact the Canadian economy. So, once these tariffs are applied, and that's really the flag that's shown on this slide, the next thing that we need to start thinking about and the next focus will be what impact they have on demand. So the way this transmits to the economy is, of course, when the US imposes tariffs on Canadian exports, demand for our Canadian exports certainly will see a decline. You'll also see price increases on the US side because these tariffs automatically increase prices for certain Canadian exports. And in the case of the past weekend, it was broad-based. It was a blanket tariff across all Canadian exports. So significant price increases lead to a disruption in demand for the Canadian exports. You also have retaliatory measures that are proposed. So in Canada, we saw, the Canadian government suggest that they would propose roughly $155 billion tariffs on $155 billion of US exports into Canada. So on the flip side, certain prices in Canada would also see increases, and that would lead to a reduction in demand for those goods that the US is exporting into Canada. Then once those two things play out, we likely see, and this is the big question mark, it depends on how long these tariffs are implemented for. The longer they're implemented for, you're going to see more significant impacts on the economy. You start to see firms begin to lay off individuals. if their demand for their goods are you start to see demand for their goods decline. And that leads to secondary impacts on industries like services, whether it's restaurants or hair salons or things of that nature that also experience these knock-on effects from the tariffs. And then that really brings us to the biggest question, which is what does the Bank of Canada and what does the government of Canada do here? Now, for the Bank of Canada, they're kind of facing two questions here, and ultimately their response will be determined by the answer to these questions. One is certainly you're expecting to see a reduction in demand, which should lead to a reduction in GDP. But at the same time, you're also experiencing an increase in prices. And as we know, the Bank of Canada, when they cut rates, typically though that leads to inflationary pressures. So depending on which of these factors prevail, whether you see demand disrupted and you have GDP contracting, certainly in that scenario, the Bank of Canada would step in to cut interest rates. But on the flip side, if the impact on growth is minimal, and you start to see price increases due to the tariffs, the Bank of Canada's hands may be tied to a certain extent in the way that they can step in and provide some relief. Similarly, for the fiscal policy response, there's a lot of question marks around what that might look like. Will it be targeted towards industries or consumers or individuals that have been directly impacted from these tariffs? Or will it be more maybe medium-term focus where you have tax cuts for businesses that spur on business investment and ultimately improve the outlook for the Canadian economy over the medium term? So ultimately, all to say is that the precise impact of these tariffs on economic growth will depend on how these things flow through and how the monetary policy response and fiscal policy response look like. So the next slide here, what we've shown is the peak to trough or the decline in GDP that the Bank of Canada has estimated as a result of a 25% tariff. And that's the bar all the way on the right side of this chart. As you can see, it's a range of outcomes that the Bank of Canada expects as it relates to the impact on GDP. You have a range. So it really depends on the answers to those questions. If we have tariffs in place for longer, certainly the expected outcome is a much more negative outcome than if we have a shorter period of time where the tariffs are implemented, as an example. But all to say is that you could have these tariffs implemented for a very short period of time, and as a result, less disruption to the economy, which is why you may not actually see a contraction or a minimal contraction in GDP relative to a scenario where we see the blanket 25% tariffs implemented for a longer period of time. And in that case, certainly you could see a recessionary outcome. The other bars on this chart are historical recessionary peak to trough declines in GDP. So we don't know exactly how the impact of these tariffs we don't know the exact impact of these tariffs on growth, but certainly there's this range of outcomes that the Bank of Canada has provided us with last week in their monetary policy report. So I guess moving away from tariffs, and as Lorne kind of alluded to at the outset of the call, when we take a step back from the tariffs and we think about the outlook for Canada as we were looking into 2025, economic growth in Canada is actually expected to improve relative to the growth we saw in 2024. These are the IMF estimates that were published a few weeks ago in the middle of January, but similarly last week when the Bank of Canada published their estimates, they actually projected economic growth improving from the levels that we saw in 2024. And a large reason for that is because the Bank of Canada, as you can see on this slide, has cut interest rates by 200 basis points over the past 6 or 7 months. They began their easing cycle in June. And really, we haven't yet seen the full effects of these interest rate cuts permeate through the broader economy. But as this stimulus or as this easing permeates through the broader economy, we do expect to see a pickup in activity barring these tariffs. So that's really the uncertainty right now. I'll hand it back to Lorne to kind of speak to maybe the interest rate outlook and some of the thoughts around the Canadian dollar.
Sure, thank you. So as I mentioned,
Sorry, Lorne.
sorry. Yes.
Can I interrupt for 1 sec? I have a question here that applies to what you were both just speaking to. The question is asking, as of now, the tariffs seem to be product specific. Is there any intention to make them service specific as well?
Happy to.
Or sorry, so the tariffs as of now are focused on goods.
Yeah.
Yeah.
Has there been any speak about service-based businesses?
So the quick answer is no. There have been questions about that, but frankly, at this stage, it looks like from the U.S. perspective, they're a huge exporter of services, not a significant exporter of goods. So they are keeping the focus very much on goods and on the manufacturing sector of the economy, rather than bringing up the counterintuitive or counter argument of services, which the U.S. wants to continue to export. On the Canadian side, I have read about the possibility of the Canadian government using the retaliatory tariffs and gearing them towards services, U.S. services, to try and inflict a bit more pain, if you will. But again, I think it's a very, very low probability. So it's a great question. It just seems as though this really is a question about the goods side of the equation and very little focus on the services side. Do you have anything else to?
No, I think it's a great question. Certainly can't dismiss the possibility of something like that happening, especially on the retaliatory side. But right now, the focus has been on the good side of the economy for sure.
Excellent. Thank you.
You're welcome. So on this next slide, what we're showing here is basically the path of interest rates across five or six different major central banks, call it developed market central banks. Canada is the dark red line. You can see how, with the exception of one, the blue line at the very bottom is actually the Bank of Japan. They're coming off of effectively negative interest rates for over 10 years. They're just starting, they're actually enjoying and have enjoyed this uptick in inflation. They've been struggling to get inflation in their economy. So they're just starting to incrementally raise their interest rates. Currently, their overnight interest rate is actually at 0.5%. All of the others have really, they were synchronized on the way up in response to this excessive inflation that we experienced. And it wasn't a Canada-only story. It was really across both developed and emerging markets. But you can see that sequence of interest rates all went up. They all kind of hovered at very, very high levels, at least for called the medium-term history that we've all experienced. Going back 15, 20 years, these are relatively high levels, not seen since the mid 2010s. And then we started to see inflation easing and central banks started to take action. As you can see, the red line is the most aggressive downward move. So as Neil was showing on the prior slide, the Bank of Canada has gotten way ahead of most other central banks, become much more aggressive in their cutting process, the pace and depth of those cuts. That is adding fuel to our economy. There's a fast transmission of lower interest rates into the economy. So it's helping support an increase or return to activity. And the question is, where to from here? And I think without the tariffs, we would argue that we probably have another 0.5% to go. So currently the overnight Bank of Canada rate is at 3%. We would anticipate over the next 6 months or so a move down towards 2.5%. However, if we see considerable tariffs implemented, and if they actually last, they're more permanent, we could see a more significant move lower in Canadian interest rates. We don't think they're necessarily going to be emergency type of moves by the Bank of Canada, as Neil was outlining. The Bank of Canada needs to balance the risk of higher prices or inflation materializing from tariffs with a real severe deterioration in economic activity, meaning shifting from a projection of growth for the economy to a projection of contraction or recession. So the Bank of Canada, I think, first will watch to see how the federal government responds, what those programs look like, how they're targeted, what kind of size, how quickly can they actually have an effect on the economy, on jobs and so on, before they would actually take action on interest rates. That's our take at this stage. Obviously, things can change, but we did want to provide you with a quick sense of where we think interest rates go. So, you know, and again, just to repeat myself, in the scenario of no tariffs, I think we could get to 2.5%. In the scenario of more of severe tariffs and more prolonged or permanent tariffs, we're probably heading towards 2%, if not below. Shifting gears a little bit, still to talk about Canada, what we really want to highlight here is first, you looking at the chart on the left-hand side, this is an index that just assesses level of certainty or comfort within the broader economy. And what it's telling us, and you know, for obvious reasons, as we've just discussed, uncertainty is very, very high. When you don't know what the trajectory for the economy looks like, if you don't know what is going to happen with your federal government, given the situation we find ourselves in right now, that uncertainty naturally will become, that discomfort naturally picks up, and we all feel it. So I think it's important that we have these types of discussions where we kind of unpack it and say, well, are the risks really as severe as we fear? Are the probabilities strong that this occurs, that we have a big collapse? And for the time being, I think the message from us is, no, we're not concerned about a severe downturn or pullback. We kind of see a path to where tariffs can be avoided or at least minimized. Going back to that American first trade policy and the focus on Canada. So that U.S. trade policy, though, is certainly contributing to the uncertainty. And then the second component is the Canadian election and what is the direction of political policy, fiscal policy going forward. So I'm sure you're all aware and following this through the news and otherwise, but we're in the midst of seeing a Liberal leadership race. The timeline is, I believe, by March 9th. That is to be decided. March 24th, the prorogation of the Canadian Parliament comes to an end. Parliament comes back. MPs come back to Parliament, sit in the House. At that point, it is widely expected, based on what leaders of the other parties have said, we will have a vote of non-confidence. And that will trigger an election, which tends to happen, I believe, is required to happen within 35 days of an election being called. So that puts us into early May. Right now, the polls would suggest the Conservatives will have a majority. But of course, with the leadership, you know, we'll call it the front runners in the Liberal leadership race are really shifting their tune a little bit. And, you know, talking about the carbon tax, talking about what we call business-friendly type of decisions or policies. In either outcome, whether it's one of these front runners with the Liberal Party or it's the leader of the Conservative Party, if whichever one is our future Prime Minister and leading government, we feel fairly strongly that we're going to see what we think are pro-growth type of policies moving us forward. So yes, highly uncertain right now. Uncomfortable with the uncertainty, but we see this coming to a rest. And as we get more clarity on the government, we get more clarity on trade policy in early April. I think it's fair to say that this uncertainty index will roll over and head back down towards more normal levels. Next, I wanted to just touch on the currency. So the Canadian dollar, which has been a lightning rod for all of this uncertainty. We want to put it in context. If you look at the chart on the left, the Canadian dollar, these are all currencies relative to the US dollar. So in the currency world, we don't look at a currency in singularity. We look at currencies relative to another currency. So these currencies are all relative to the US dollar. We can see that they've all lost ground. This dates back to the day after the US election. So when the results were known, how did currency markets react? And obviously through all of the events that we've had since then and all the news, how have these currencies held in? The Canadian dollar is in the middle of the pack. However, hugely volatile. But the good news is it's not like the Canadian dollar is an outlier. And if we look on the right-hand side, yes, the Canadian dollar is weak. We're down around right now 70 cents. We have been as low in the early 2000s as about 62 cents. Question is, where to from here? And the fact of the matter is, if we do have high permanent tariffs, the risk is we get, it's not just a risk, it's actually a positive. You get a weaker currency, which helps offset some of the economic impact and the export costs, or it continues to give our exporters a bit of an advantage or a bit more margin back with a weaker currency. So I could give you a whole slew of different possible outcomes. I think right now it's a bit unclear as to how severe those tariffs are going to be. A little bit further Canadian dollar weakness is entirely possible. But if we do avoid those tariffs, and going back to the story that Neil was sharing as far as why we think there's actually considerable upside for the Canadian economy. So that's lower interest rates, increasing activity, a business-friendly or business-focused new government in place. We actually think the outlook for Canada is actually really, really strong. And on that basis, we start thinking about, well, let's think 6 months out as all of this kind of settles into place and becomes less of an uncertainty. We could actually start to see the Canadian dollar strengthen again. So again, we're at very low levels historically for the Canadian dollar. We could see further weakness depending on the tariff side, but provided we avoid those risks, we actually see a light at the end of the tunnel and room for improvement for the Canadian dollar. But that's really a medium term, 6 months, 9 months, 12 months down the road. And with that, we'll hand it back to you guys and happy to answer questions and discuss anything you'd like.
Perfect. Thank you, gentlemen. Appreciate it. Does anyone at this point in time have a question that they would like to ask either Lorne or Neil? If you do, you can put it into there's a box at the top that says Q&A.
Please don't be shy. We're happy to discuss anything.
So while we're waiting, I'll just throw this out there. Do you guys have any thoughts in terms of portfolio allocation? Is there anything you're thinking of in terms of new direction or any specific unique direction based on what we're currently experiencing?
I think there's a couple of things. So from a high level standpoint, without getting into, we like this name or that bond, I think in general, given the high degree of uncertainty that we were discussing and circling back to those 2024 returns that we were showing on that first table, we're in a considerably more challenging environment from an economic standpoint, from a geopolitical standpoint than we were 12 months ago or than we were 6 months ago. So I think it's going to be a more challenging environment to achieve those types of returns again this year across asset classes. It's not necessarily picking the right one. I think it was just a phenomenal year. I think we look at diversification, of course, as an important approach. But we also recognize, because of the higher degree of uncertainty, we become a bit more defensive. So what does that mean? Well, think about lower volatility types of sectors or styles of equity. So even to put it in a very easy to understand context, growth stocks have done exceptionally well. And of course, there's justification for that, and it could continue. But when you think about lower volatility type of characteristics, we tend to lean a little bit further over towards value. You just get lower volatility in that environment. And then I think equally from the interest rate side, we invest, of course, across the whole spectrum of government bonds and credit, being investment grade or high yield. And we continue to see opportunity there as well. In the high yield area, investment grade just providing slightly smaller or lesser returns, but at a higher credit quality. And then from a bond perspective, we've seen a lot of progress in Canada. We've seen a lot of strength on the Canadian bond side. I think there's potential on the U.S. side, of course. Tariffs. It's that big question mark, that huge amount of uncertainty that comes with tariffs and the risk of inflation, and higher inflation would take interest rates back up. So that's not going to be good for a bond portfolio. But again, that's not necessarily our base case. Even in the US, we're anticipating rate cuts, not necessarily as a catch up to where Canada's gotten to, but we do think that we could see 2 or 3 rate cuts out of the US once we get through some of the, call it, first few months of Trump activity, Trump noise, and things kind of settle back down.
Perfect. Thank you. I have a question here that came in. Is there an opportunity to take advantage of the strength of the US dollar in the portfolio? So converting US to Canadian assets and so on and so forth.
So I'm going to answer that 2 ways to give you a sense of how we do it in our portfolio. So in some of our larger, what I'll call balanced portfolios, so it's a cross asset. We have equities, we have bonds, we have credit in there. We're invested not just in Canada, but in the US and other jurisdictions. We actually look at the US dollar as a bit of a portfolio hedge. What that means is the traditional relationship between the US dollar and what we call risky assets. So equities to a certain extent, as you think through the risk curve, your bonds are probably at the lower end, and then depending on the type of equities you're in, kind of go up that curve, and you want a nice balance across the whole curve. But we think about the US dollar as a counterbalance to some of the things that are further out that risk curve, because in an environment where you see a sell-off in equities, historically you'll see the US dollar strengthen. So it's a bit of a natural hedge. So we maintain some US dollar exposure in some of those funds just as a natural offset in case we get into some sort of environment where, equities have just run too far and there's a sharp decline. Well, then at least we're offset from a performance standpoint, protecting the portfolio. US dollar should strengthen a little bit to help us out from that perspective. From a should I reduce my US exposure to buy Canadian because the currency is Canadian dollars is very cheap, and therefore you want to be buying when things are inexpensive and selling when they get overvalued? I think there's some merit in that. I would just caution, as I was saying when we were looking at that currency chart, there's really, I would say, 2-way risk right now, and I would almost call it asymmetric risk for the near term, where you could see the Canadian dollar strengthen, but marginally. And why I say marginally is because right here, right now, with US interest rates much higher than Canadian interest rates, that draws investment flow into the US dollar away from the Canadian dollar. Because if you just think about, I have $100 to invest, should I invest it in US dollars where I can earn 4.25% is their overnight rate? I appreciate we can't all get that, but call it 4.25%. Or should I invest in Canada where I can earn 3%? So the natural answer to that, of course, is we'll go to the higher interest rate. So over the near term, that's going to support the US dollar and keep the Canadian dollar from strengthening too much. over the long term, if tariffs do go away and we start to see some improvement in the Canadian economy and the US interest rates can start to come off, then Canadian dollar can start to strengthen more meaningfully.
But in the interim, the risk is we get this blunt force tariff. And like I said before, that release valve or that lightning rod is the currency.
And the currency could weaken quite aggressively, quite quickly.
So I'd say it's a lower risk, but something where over the very short term, we can't downplay altogether or disregard.
Great. Excellent. Okay, we have a few that are coming in. I'll just start from the top. So because global economies are so linked and tariffs are threatened in multiple geographies, do you believe that this could lead to any crashes in a particular stock market?
Yeah.
So I think that, so to the first part of the answer, totally agree. I think if you were to see an increase in, and please jump
Sure,
in,
yeah.
But if you were to see an increase in tariffs, say targeted at China, let's think about, okay, US is the largest economy globally. It represents roughly 18 to 20% of the global economy. Number two is China. And I'm going to use round numbers, but say about 15% of the global economy. So if you start to see this kind of protectionist trade policy really ratchet up, like way more than it is at this point right now with 10% tariffs on China. The fear is, of course, the global economy will start to tighten up, will start to slow. What does that mean for equity markets? I think equity markets as one driver depend on earnings growth. Earnings growth in part comes from continued economic growth and activity and demand. If we start to see a pullback in that level of demand, equities struggle. I'm not answering your question on which equity market goes first, because frankly, it's going to depend on so many variables. But the US I shouldn't say the US tends, the US has been the leading equity market and the strongest equity market in recent times. So I would suspect that we look at, while we could point to Chinese equities, we could point to other countries, US is where we need to look to first for leadership. And some of the other countries, from a valuation standpoint, are already at huge discount relative to the US. So I think I would look to the US first and expect others to follow quite quickly.
Perfect.
Yeah, quickly just adding on that, Lorne raised a good point. In answering that question, I think a question was asked earlier about allocating, it kind of ties back to what we've been saying about Canada and how valuations are on a relative basis cheap. So when we think of our economic outlook, and if we have some of these concerns moving into the rear view as we look into the second half of 2025 or even 2026, you may want to start positioning to get ahead of that, especially if we are of the view that Canada will be less targeted than some of the other economies like China. And ultimately, the question about the duration really comes up. If the duration of these tariffs are, applied for a longer period of time, it has greater consequences to reshape global trade. But if, given what we've seen over the past couple of weeks with Colombia, Mexico, and China, it seems as though maybe the length of time that these tariffs will be applied for may not be for a significant amount of time, and that will limit the amount of restructuring in global trade. If you're a business and you're looking to kind of think long term, maybe you eat the costs of those tariffs in the interim, pass some of those costs on to consumers before you look to reorganize your supply chain.
Great.
Mike, can I just mention something that I think might be helpful for people to hear? So with all of the uncertainty that's been happening, you had the US inauguration, you had all of this news about the Chinese AI shop DeepSeek coming out early last week. Of course, you have the tariff threats that really escalated in a hurry over the weekend once they were actually announced and put into executive orders. On our side, we have a team of senior portfolio managers who are constantly discussing all of these risks together. And much like Mike and Nick would be doing the same and are interacting with our teams as well. We came together as an example yesterday at 7 a.m. in the office. We had about 15, 18 people all around the table to discuss, okay, what does this mean? And do we need to react? And the point I simply want to make is I've been through worked through some big crises. So, thinking of the global financial crisis, thinking about some of the events we saw from China in 2016, thinking about, of course, March and April of 2020, when the pandemic really hit and markets started to react and liquidity across markets became a constraint. What you learn through these instances is not to overreact and rather think through what all these risks are, think through from a more statistical standpoint, what are the probabilities on the various outcomes? And then eventually, and not necessarily trying to create this long, lengthy pause and forced wait period, but to be thoughtful before we act. So rather than act first and think second, we take an approach of think first and draw on the cross-region and cross-asset expertise, and then make decisions on how to adjust our portfolio. So yesterday, we made in certain portfolios some very minor adjustments to get a little more defensive, but for the most part, we did not make any significant changes. Yeah. We were prepared to. We understood what those watermarks were that would trigger us to make those changes, but we didn't get to them. So I know that doesn't answer questions with asset class specific responses, but it kind of gives you an idea of how we try to approach and be a bit thoughtful and careful and thoughtful in how we make these changes, how we respond.
Perfect. Thank you.
And one point on that, Michael, to add to that, Lorne, we were looking at performance through all this uncertainty, whether it's, the inauguration day, whether it was, this Monday, the tariffs. If you look over if you zoom out and look at the performance of the S&P over the past month, we're actually kind of seeing a relatively calm market. So again, certain days feel like things are falling off a cliff, but over a zoom out and you look over a kind of 1 month, 2 month period, you're in, a pretty relatively calm or if not upward market. So that's kind of another point we were kind of looking at this morning and just kind of reflecting on and, definitely kind of thinking about as we move forward.
Great. Excellent. Are you able to comment on the interprovince trade barrier reductions and how does that translate to portfolio strategy, if at all?
Want to touch on that or?
So the number that I've read from numerous sources and researchers is interprovincial tariffs amount to a tariff of roughly 21% across the provinces. Now, I appreciate that's going to change from one province to the next, but that's a pretty big hurdle to overcome for trade within a country. I think what has come of the Trump threats, and as early as when the first tweet or social media post came, which was, I think, late November, early December, about 25% tariffs on Canada. Having seen this Team Canada come together of all of the provincial premiers, and coordinated, of course, with the federal government, I think it's increased, it's magnified that 21% tariff barrier. And I do think that we will start to see steps towards removal of some of those issues. Now, some of it boils down to, it could be, a builder in Quebec can't go and build in Ottawa. Different requirements, different, safety issues, insurance issues, licensing issues. It's not as simple as flipping the switch, I guess is the point I'm trying to make. So I do think that we'll see improvement in that direction. I just don't see it happening immediately. But it feels like such an easy change or shift to make to allow our economy within Canada to actually operate more efficiently. Now, I guess one other thing that does come to mind when you think about access to energy for all Canadians, it's so strange to me that we're producing an incredible amount of energy out in the prairies, and the vast majority of it goes directly south. And then ultimately, energy finds a way from the south back up to the east. Why are we not selling the energy we produce there? And I appreciate there's refinery constraints and other issues. Why aren't we actually trying to buy energy from ourselves or supply energy to ourselves?
And equally, why aren't we setting up pipelines, LNG processing capabilities, ports on either side of the country? Now, we now have an LNG port on the West Coast. Why don't we have it on the East Coast? Why aren't we expediting these things? Some of that is interprovincial regulation or limitations. So we really do need to see those barriers come down. So I think, like I said, I think this whole U.S. tariff story has probably expedited that process, lit a fire under them to say, listen, let's get this fixed. Now, how quickly that happens, particularly in a country like Canada that tends to be covered in red tape at times, time will tell, but hopefully we do move in the right direction there.
Perfect. Because of the uncertainty in the US, do you see many snowbirds selling their assets and getting rid of US assets?
I think it could become a theme if this were to be long lasting. I don't think it's necessarily, listen, and by the way, this is my personal opinion. It's not based on any data or anything or else. I simply think there's a draw to the US, to the southern US, which is warmth during our cold months. Tariffs are an economic issue, not a social issue per se. I don't think there's a reason why Canadians should feel uncomfortable being in the US or uncomfortable holding US assets. We're not talking about a situation where capital controls come into place and any money in the US can't be removed or pulled out.
Like, we're not going into that kind of situation.
Does the currency factor into it? Maybe. It's expensive for any of us to book a trip and go travel to the US right now. More expensive than it's been in years. Which makes it important to buy real estate in the US. But equally, on the flip side, if you have real estate in the US, you're not necessarily using it anymore. It might be a time where people think about liquidating or reducing some of their assets. So to answer your question, on net, I don't think it triggers a big change there.
Perfect. I'm going to ask one more. It's a bit later, and it's another opinion piece. I don't think, obviously, you'll have the answer, but can you speak to Trump's rhetoric about the 51st state? Like, what is there anything you can say to that?
Well, again, it's pure opinion. I don't know if you want to. Why don't you start?
This is probably one of the most challenging questions to answer. It's completely, opinion, but my sense of it is that it is more of a negotiating or kind of, tactic to kind of ultimately lead to a better outcome at the negotiating table. But I think that ultimately, it's something that we don't see, in terms of probability of outcomes and base case scenario. That's not something that's kind of within, I think, the middle range for our base case or even some of the probabilities that we're considering. Lorne, I don't know if you have any thoughts on that. But
I think if you realistically, Trump in his first term, obviously there was the NAFTA renegotiation. I think there was also, if you recall, the G7 meeting that was hosted in Quebec.
Mm-hmm.
There was a lot of, let's call it, less than friendly rhetoric back and forth between Trump and Trudeau, or at least from Trump towards Trudeau. I think there's a bit of a hangover with that distaste of from Trump towards Trudeau. We could debate whether it was strategically smart of Trudeau and Dominic LeBlanc to jump on a plane and go down and see Trudeau before he was even inaugurated in Mar-a-Lago, but after the threat of tariffs had been announced. So I take it more out of that lens, that this is a bit of I'm trying to think of a respectful way to say it. So I'll just say a way for Donald Trump to have a go at Trudeau and really undermined his credibility and his popularity. And even when he had an impromptu press conference or responded to media on Sunday night as plane landed before he got onto the, what's it called, Marine One, his helicopter to go to the White House. And the question came up about Trudeau, and he just said, "Oh, Canada doesn't have a very good leader," but that's going to change. So that's how I look at it.
Perfect. Well, gentlemen, thank you very much. We're gonna call it there. I appreciate your time and your insight, and thank you very much for participating.
It was our pleasure. Thank you for having us.
Thanks for having us.
Okay, thank you. Take care, everyone.